at Peapack Private for more. David, thanks a lot for joining us. We have seen North American markets trade down now they were sharply down last week, and here in Canada we've been down for a couple of weeks. You say in some recent commentary that some key tailwinds to the markets, some key factors pushing the markets higher have begun to unravel, and one of those is this view that the Fed is going to continue cutting interest rates in a very liberal fashion.
Yeah, absolutely, Paul. Good to be with you here today. So one of the key tailwinds that have kept Wall Street very bullish and allowed us to have our second 20% plus return this for 2 years in a row has been the thought that interest rates are coming down. That's the key mantra. And that makes all the sense in the world, because if you can pay less to borrow, to buy a car, to buy a home, or to do a capital expenditure at your business, you're going to do more of that. And of course, that makes stocks relatively more attractive relative to bonds. But now that story is starting to unravel. And of course, we got the determining news on that in the press conference and the report from our Federal Reserve last week. Instead of 4 rate cuts, we're looking at 2 based on the dot plots. In terms of where interest rates are going, and the terminal rate is higher than been projected. And now many analysts are saying there's a 1 in 5 chance we see no rate cuts next year. If you look at history, there's been a pause. Sometimes pauses are just a pause, and sometimes pauses are that's it. So it's, I think the Fed will tell you it's all data dependent, but what did they see in September that they didn't see now in December? So anyone who's thinking the Fed's going to bail you out with lower interest rates has to be far more cautious.
You also think there's an important takeaway from the government shutdown standoff that was resolved in a fashion last week. The important thing, I believe you think, is that there was no lifting of the debt ceiling, which calls into question how stimulative a Trump administration and a Republican Congress can be. Particularly, they may not have room to cut taxes as much as markets had hoped, correct?
Paul, you're absolutely right. So part of the rally that we saw with the Trump election was based on, the great news that was going to come out of the new administration. We were going to have an extension of the Trump tax cuts, potentially lower taxes on corporations if they do most of their business here in the United States. And of course, we're going to see less regulations, more efficiency, and so forth. And basically, with the Republicans controlling the Senate and the House, all these different initiatives we're just going to steamroller through. But what we saw, of course, with these budget negotiations is, in fact, a big pushback by fiscal conservatives in Senate, even in Mr. Trump's own party, saying, hold it, we are not going to take away our responsibility to ultimately decide how much money this country is going to spend. It's not going to be all up to the executive branch. And that's one of the reasons they have that debt cap. Mr. Trump, of course, wanted that removed. That would just allow him to let the deficit go as large as he felt was prudent. But, particularly some of the senators said, we're not going to give up that job to monitor our fiscal health. And so I think now Wall Street is saying, well, where else are Congress going to push back on some of Mr. Trump's policies here? And what does that mean for our bullish tailwind for 2025 in stocks?
So you think some tailwinds have faded away. Does this mean you're negative on U.S. stocks in 2025?
That's too strong. We think that, again, there are opportunities, and I think some of this has been opened up because of the recent market reaction. Now, everyone says that, Mr. Trump will be great for stocks in 2025, but if you look at the equal-weighted S&P 500, we're back to levels we saw in September. All of the so-called Trump bump post-election is gone. So some of that has now been wrung out with a equal-weighted S&P 500, now down 7.5% this month. So I do think that if you start looking at some of the more value areas, there are going to be opportunities. But the other thing, Paul, I got to point out to you here is that the yield on Treasury inflation protection securities, TIPS, is now at 2.3%. We've rarely seen that. And of course, that is going to be a headwind as asset allocators say, where do I put my money in 2025? If you can get 2.3% guaranteed over inflation, that takes some of the attractiveness off of stocks and, of course, alternative investments as well.
One sector you're watching is the media sector, and one stock within that sector you're watching is Paramount. Why so?
So I think this is a special opportunity here. The big change, of course, there's two factors going on. One, of course, the stock is down about 2/3 from where it traded 3 years ago. Still has these storied assets, CBS, of course, Paramount Studios, a whole host of other content brands, plus their Paramount Plus streaming. But I think the big new factor here is the coming in of the Ellisons. The Ellisons, of course, are some of the wealthiest people on the planet. And when people talk about, well, financial troubles that Paramount has, the Ellisons can make that just go away, but that simply. When they do business, they are so successful, that family. And for those who are football fans, I say, look at what happened between LSU and Michigan. LSU wanted a quarterback. Michigan came in, got the quarterback with a huge package, monetary package for the quarterback, all because of the Ellisons. So when the Ellisons play, they play to win. And of course, when the deal closes, if it closes with Skydance and so forth, many people will be able to cash out their current stock that you can get today at about 10 or 11 at $15 a share. That's a 42% return. Now, there's some hair on that deal. Not all shares can be tendered. But I mean, if they're willing to pay $15 for half the shares and the stock price is now 11, you got the Ellisons coming in, it seems to me is a nice risk reward situation, Paul.
I don't want to get sidetracked into a sports conversation, but is it not against the rules to encourage young athletes to come to colleges with financial packages?
Well, the rules are changing. I don't want to go down that rabbit hole either. But in terms of payments that are coming because of their name, image, and likeness, and so forth, people are in effect are now getting paid to play.
Okay, David Dietze is our guest. We're going to have another segment with David right after this time to talk about